Well, hello everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and with me today is T3 Trading Group Senior Trader Derrick Oldensmith. Hi, Derrick. Thanks so much for joining me for this today.
What's up, Greta? It's good to be back.
Yeah, glad to have you back. All right, so as you know, the first question I ask everyone here is to give me a grade on your week of trading so far. So we're halfway through the week. What's your grade on your typical grading scale in school, A through F?
I've been trading really well recently, and it's been a pretty good consistent year for me as far as my trading goes. And this week's been great too, despite a lot of headaches. I mean, I have to give myself an A plus because I am typically a bull. I think everyone knows that. I think I have a reputation for being a bull. I have a reputation for really focusing on the long side of the market. I prefer to be on the long side of the market. And I started to develop a little bit more of a bearish thesis like the beginning of last week. And then it was pretty much as of yesterday that I think I got net short for the first time, maybe the first or second time this entire calendar year. I got pretty solidly net short yesterday. And then maybe, little luck, or as my friend Scott Ruther likes to say, what is luck, right? It's when hard work meets I forget exactly what he's been saying, but he's been saying it for years.
Yeah.
Hard preparation meets hard work, or something like that, is
Something like that, yeah.
what creates luck. I've always enjoyed when he has said that, even if I haven't been able to quote it perfectly. So, really got net short yesterday, and then the whole Fitch thing, big gap down this morning from markets, and I got paid pretty well on it. So I'd have to give myself a solid A plus on my trading this week, despite kind of a bunch of headaches. I took a red eye back from Los Angeles Sunday night into Monday morning, barely slept at all, and immediately dove right into my trading on Monday. Then today I got to the office and my computer decided it wanted to blow up last night and it wouldn't turn on. So I'm trading on a different setup. I'm trading on Josh's computer. I'm talking to you from Josh's computer today. And his light speed froze for me 4 times on his computer for whatever reason. So I don't know what the deal is with his computer. I just seem to have the magic touch when it comes to technology. But despite these headaches, I was able to keep a pretty clear head with my trading, make good decisions, follow my edge, follow my strategies, and it's been a pretty good week so far.
How important would you say it is to have, a solid strategy, a solid game plan for times like this week when you kind of have all these outside factors trying to make trading harder for you?
So, well, that's the key to it. And I say it all the time. The key to any difficulties that you're encountering, whether they're psychology issues that are negatively impacting your trading, or you didn't get a good night's sleep, or whatever personal life event has happened to you that could negatively impact your ability to trade, the counter to all of that is good game planning. It doesn't matter how tired you might be or whatever the situation is. If you have a solid game plan that's based on rules that you already have developed for yourself for your trading, all you need to be able to do is to be able to follow it. And on Monday, I was so tired. I felt like I was talking into the virtual trading floor. I wasn't even sure if I was making sense. I pressed the wrong button. Everyone presses the wrong button with their trading once in a while. You press the wrong button. I still probably do it once every few months or whatever. I think I pressed the wrong button like 6 or 7 times on Monday. I was getting like so frustrated. I was like all backwards on my keys and everything. But I had a really good P&L day on Monday, and it was just very simple. I just had a game plan. I followed the game plan. It didn't matter that I was tired or whatever. I didn't deviate from it, and was able to give me some success.
All right. So for everyone who is here with us live, just a reminder that this is a Q&A session between me and Derrick, but also a Q&A session between yourself and Derrick. So in the live chat, I have just put a comment where you, just so you can see it, submit all your questions for Derrick there. And then in the second half of this, I will ask him all of them. So we will make sure to get to every single question that is submitted during this event. Just pile them up as they come up in your mind. All right. So Derrick, you mentioned it. We had a big downturn on Wall Street today after Fitch Ratings downgraded the U.S.'s long-term rating from AAA to AA plus overnight. Now, that was a surprise. The move comes after Fitch did put the U.S. on negative watch back in May amid the debt ceiling battle that we were having back then. And I did have you on this program then, and we talked about, that debt ceiling issue that was going on then. Do you think today's reaction in the market to that downgrade was warranted?
Well, my understanding of history, which, and I didn't do the research myself, it was one of the members of the VTF told me, is that the last time we had an event like this occur, which I believe was in 2011, the market went down like 7% or something like that. So today I'm looking at an S&P as of right now, including any after hours trading, the SPY is down 1.4%. So it's still a pretty decent reaction to the downside, but it's relatively muted. I'll be honest, I don't think that people overly care about this Fitch downgrade. I do think that the market was already looking for a reason to pull back and a reason to sell. And this kind of gave it that reason. And, we broke some key technical areas, which markets work in feedback cycles. They work in feedback cycles on the upside, feedback cycles on the downside. So when you do get that excuse to start selling, that selling could lead to the breaking of key pivot points in the market, key levels in the market that could trigger the next person's stop loss, which triggers the next person's stop loss. So selling leads to selling. Markets work in feedback cycles over time. So looking at the S&P down 1.4% today, the NASDAQ down 2.2%, those are pretty solid down days, but I don't think that it is anything to be overly concerned about. I mean, you look at the NASDAQ. The NASDAQ is coming off of its best January through end of July period ever in history. In the history of the markets, we're up 44% as of the end of July in the NASDAQ. I mean, that's an incredible number. So, okay, we're up 44% in the NASDAQ as of the end of July, and we have a 2.2% pullback on a Fitch downgrade. It's not the end of the world. It certainly could lead to more selling. I mean, like I said, we broke some key levels today. I don't think that the low we put in today is going to be the absolute low. And, today's low is it. Next thing you know, we're making new highs or making new all-time highs. I think that this pullback on the market is going to take some time to heal. But I'm not so bearish that I'm looking for, a 10 or 15% or 20% down move. I think, ordinary 5% pullback from the market makes sense. History shows that we have a 5% pullback in the S&P once every 8 months. And we already had one today, I think one this year back in February. But having another one after the run that we have had, I think it makes total sense just to retest some levels from June, maybe, like pretty recently, just levels from a couple months ago on a pullback on the market to retest those levels. And if we retest those levels, I will almost certainly be coming in and being a buyer on that broader dip. But it's just it's been an incredible year, and there's a lot of information, a lot of data that points to the need for a pullback. And then the Fitch thing happens, and I happen to already be positioning myself to the short side based on other things that I was looking at. And we had a decent sell day today. This is nothing compared to the sell days we saw back in 2022. It's just one trading session.
Yeah. You said that you had already shifted your strategy more toward the short side based on other things you were seeing before this happened. So what were those other things you were seeing in the market that were pushing you to change your strategy?
Sure. So there was a few things that I was looking for. I started to turn a little bit bearish as this earnings season began. And if anything, the one portion of my thought process that made me a little bit more bearish, which was earnings, has actually proven to be completely wrong. So one piece of information that I was thinking was, again, it's been an incredible year. The market's had a huge run. What I've seen over the course of my trading career, and we might have spoken about this a little bit last time, is when the market's been really weak and it's been selling off a lot, and then you come into earnings, mediocre earnings reports that are roughly in line, tend to lead to stocks moving higher because expectations are so low, everything's so beaten up going into the report. The opposite is often true a lot, where if you've had a really, really big rally, which we've had that, it's been an incredible year, and you're trading at highs, and then companies report mediocre earnings reports, they're roughly in line or whatever, you have a higher probability of stocks selling off on those numbers. And while we haven't seen Apple and Amazon yet, which are going to be two of the biggest and most important ones, this earnings season thus far has been absolutely stellar overall. The companies have been crushing it, kind of one after the next. I think about 80% of companies have beat their estimates so far this year, but the quality of the beat is actually significantly higher overall as a percentage of companies that are reported in the S&P. The degree to which companies are beating is higher than in a typical earnings season of companies that beat, if that makes sense. So it's been a phenomenal earnings season. You can look at the Google report. You can look at the Meta report. The Meta report was mind-blowing. You can look at Roku. You can look at Intel that just happened. It looks like Shopify after hours might have just reported some pretty decent numbers. So my thought process, one of the things that had me begin to think about this market a little bit more bearish was, all right, such a big run. If we just get some mediocre earnings reports here, which I thought could easily happen because the sell-side analysts have been expecting bad reports for quarter after quarter after quarter, and it seems like they're finally starting to throw in the towel. So it's like, well, sell-side analysts are finally throwing in the towel after we've gone up 40+% in the NASDAQ. Maybe we actually get some mediocre reports here and sell off a little bit on it. That's been completely wrong. But the other things that I've been looking at, one has been interest rates. The TLT, which is the ETF I just utilized for a quick glance on how treasuries are moving and how interest rates are moving, has been getting demolished here. It broke back below the key level of $100 at the end of July. It tried to snap back above $100, but basically just created a lower high and then rolled down really hard. Got hit really hard yesterday. Got hit really hard today. That made me more bearish. The dollar has snapped back much further than I actually expected it would. But the dollar increasing and moving higher the way it's been, it had another strong day today. That also applies pressure on the market. And then, one of the big things that I pay attention to is just market dynamic information. And what I mean by market dynamics is an understanding of things like sentiment and positioning. So from the positioning side of things, systematic funds, they have really re-leveraged themselves into the market at this point. And I think I saw the statistic that the systematic funds, which basically just trade as a function of volatility, as a function of where the VIX is trading, they're trading, they're like long at their 90th plus percentile going back over the course of 3 years. The last time we spoke, I was probably significantly more bullish. And that was probably the time when I was quoting to people that hedge funds are more bearish, they're more net short than they've been at any other time since 2011. Well, look at what the market's done over the course of the last few months when you've had all these hedge funds leaning to the short side. They've gotten completely blown up. And then I saw in the VTF a couple days ago, Josh Leffler posted information from Goldman Sachs that said that they've seen significant de-risking from hedge funds, and that de-risking has primarily come in the form of those funds liquidating those short positions. And you can see it. You can see it when you look at, Carvana or Upstart or any of these like heavily shorted stocks that have gone absolutely through the roof, and there's been these huge short squeezes on it. So the same information that had me bullish earlier this year about systematic funds having plenty of room to be able to re-leverage their portfolio as the VIX drops, about hedge funds, super short. So if this market breaks out, then, they have to start covering their positions. A lot of that's actually becoming behind us now. And it's at the same time where now you're beginning to see all these silly sell-side analysts completely chasing price up once again on all of their analyst predictions. You're starting to see, with probably an asterisk next to it, a little bit of a turn from Marko Klanovic and Mike Wilson on like the degree of bearishness that they've had. You can look at your sentiment indicators for the market, which my partner Pat posts those sentiment indicators every day into our team morning research note. That those things are like on the extreme greed part of the line. So it's the same thing that really had me bullish earlier this year, where I'm looking at cheaper valuations, and I didn't think that we were going into a big bad recession, and the market dynamics, in my opinion, were at that point extremely bullish. That's also turned. At the same time, it's after a massive rally, which has caused these stocks to become a little bit more fundamentally expensive, which, I always take that with a grain of salt. Fundamentals, it's something that I pay attention to. But broadly, a lot of this rally has been from an increase in PE multiples. So stocks are getting more expensive. So I wouldn't call myself an outright bear. I'm really not. What I want to be able to do is buy a big dip in the market. It just hit a point here over the course of the last couple of days, the last week or so, where I didn't even necessarily believe in a huge pullback on the market so much as I felt we couldn't really continue to move higher. And I wanted to position myself for that. I still have longs on. It was just I started to lean into, first UPro short and TQQQ short. And then yesterday I added Microsoft short, Meta short, Tesla short, getting all those things on my book. And that helps me to hedge the long positions that I still have on. And then at a certain point, looking for at least like a 3 to 5% pullback on the market, I'm net short for that move. But the more we pull back, and this even happened throughout today's trading session, the more we pull back, the more I'm going to be covering those shorts and piecing out of those shorts and piecing back into the longs that I've already sold at higher prices. I just want to get through this week. I want to get through Apple and Amazon. I really want to see what those reports look like. And if Apple and Amazon repeat what Google and Meta did, it's extremely hard to actually be bearish on this market. It really is, for more than just a little bit of a technical blip in the radar pullback in the market that we'll all forget about 6 months to a year from now. The flip side is, if Apple and Amazon disappoint, or if you look at like the Tesla and Netflix earnings reports, those reports were actually more of what I was looking for coming into this earnings season. They were just mediocre reports. They weren't terrible, but the market sold off Tesla and Netflix pretty hard because they had been on these massive rallies and then reported mediocre reports and sold them off. That's what I was looking for more broadly from this entire earnings season. But once it got past Tesla and Netflix, it's just been one amazing earnings report after the next. We'll see if the market continues to do that. We'll see if it happens again tomorrow with Apple and Amazon. So I'm being a little bit cautious. I'm staying nimble. I'm staying a little bit light until we get through this week. And then if, things are looking great after this week, and if I had a little bit of a technical pullback in the market, I'll be probably getting out of most of these shorts and leaning back into my longs.
Okay, so let's talk about earnings. This is technically the busiest week of the second quarter earnings season. Nearly 1,500 companies reporting results this week. So before we get into any specific stocks, talk me through kind of your typical strategy for an earnings play, and if you've had to change that strategy at all this earnings season based on the strength you've seen.
Sure. So my typical strategy for earnings depends, first of all, if I'm holding stock into the report or not. If I'm holding into the report, it usually means I'm very much in the money on that position because, first of all, I just want to repeat it. If you hold stock or options into an earnings report, you are 100% gambling, in my opinion. You have no idea what that report's going to look like. And honestly, even if you knew what the report was going to look like, you wouldn't know how the stock was even going to react to it. Because every single earnings season, we see companies that beat on all their numbers and sell off, or miss on all their numbers and go up. So even if you knew what the numbers were going to be, you still don't even know how the stock is actually going to be able to react to it. So first and foremost, holding stock into an earnings report is 100% gambling. That doesn't mean that I don't do it. I'm a big believer, and while I'm not a gambler at all, once in a while I like to play maybe a Mega Millions if it's a $1 billion plus prize, just for the jokes and fun of, hey, if I won the $1 billion, like what would I do? But if I'm in a casino, I'm going to be speaking at a conference in Las Vegas in September that everybody should go to, the Market Minds Summit, I think it's called. I can just about promise I am not going to be putting any money down into the roulette table or the poker table or the slot machines. That is not how I roll. I'm not a gambler. But for lack of a better term, to use a term from gambling, I like to play with the house's money on my positions. So if I'm up a lot of money in a position and that earnings report is going to happen, especially if it's a longer term swing position for me, I'm not liquidating that position into the report. I'm managing the position around the report. And the way I manage the position around the report is first by seeing what the measured move is from the options market. on the upside and the downside. So if I have a game plan, let's say it's a $10 stock and it's pricing in a dollar move. I don't know, just to make up some simple numbers. If I had a game plan where I'm supposed to sell some stock every 25 cents up, so it's a $10 stock, and normally if it's not earnings season, my game plan says I'm going to sell some at $10.25, $10.50, $10.75, $11 every 25 cents on the way up. But now I see the options market as I go into this earnings report is pricing in a $1 move. I will cluster all of my offers around that $1 move. So instead of selling at 10, 25, 50, 75, I'm going to take all of those offers that would be at 25, 50, 75, and I'm going to raise them to closer to that dollar amount. So I can actually make more off of the measured move that comes from an earnings report if it actually moves in my favor. And the opposite's true on the downside. My strategy says I'm supposed to be buying stock at $9.75, $9.50, $9.25, $9. The options is pricing in $1, then I'm going to cluster all those bids actually closer to $9. So that's how I approach things that I'm already in. If I'm looking at trading something after hours, it really depends a little bit more on a couple of factors. One is I will just trade directly after the report based on the news as I see it. So I traded AMD to the short side after hours yesterday. I think I shorted like above $123, something like that. If my I could be off on that number if I remember correctly. One of the things that my virtual trading floor, the ProDesk VTF, is amazing at is the news, and that's almost entirely due to my partner Pat. Though big shout out to a few other people who help occasionally, like Bill K in the VTF, or when Pat had to be out the other week, Anastasia really picked things up on the option flow for us, and I'm very appreciative of that. But it primarily comes down to Pat. Pat got news in there on AMD's guidance miss. And again, if I'm seeing Pat get it in there, it's probably really early. I saw the guidance miss, and I know that a guidance miss is really important. So sometimes what you'll see happen with the stock is the initial report hits on how it missed or beat last quarter's expectations, and the stock, let's say, has a big run up, and that's pretty much exactly what happened with AMD. And then a little bit later, the guidance comes out, and if that guidance is a miss, oftentimes you'll see not only will the stock trade all the way back down, but it might trade all the way back down and then even go negative.
Right.
So I saw the AMD guidance miss. I saw, I think the high was like 125 and change. At that point, it was trading at 123 and change. So my stop loss is going to basically be using highs at that point. I just hit the bid as fast as I possibly could, because $2 in risk, I know the name well enough to know that $2 worth of risk for the reward potential, especially post earnings, I don't remember what the measured move on AMD was supposed to be, is not that at all. So I'm like, all right, I'm gonna hit this bid real fast. Hit the bid at 123 and change. I got $2 worth of risk, and see if I can get the bigger down move off of it. So that's one way in which I trade it. I trade it just in the same way that I trade any other news event that might occur, as I see the information actually hit. So I'm reacting to the news. Other things that I will sometimes do is if it's stock that I've been trading but I've liquidated. So I've got 3 stocks today actually that I've made really good P&L on somewhat recently, but have liquidated the position entirely coming into the earnings reports: Shopify, Unity, and Lemonade. With those names, because I've already been in them, it's still a little bit of that like playing with the house's money type of thing. So for all 3 of those, I was ready to pounce on those. I was prepared on what the downside, if they were weak reports, might look like based on the implied move from options. And I was ready to come into Shopify and Unity, and to a lesser degree Lemonade, and kind of buy that dip if that dip actually came in. I do want to warn you, got to be very, very careful with what I'm talking about. There is no guarantee that a stock is going to, stop at the measured move of options. That's not some sort of surefire strategy. You have to manage risk. We will also see every single earnings season on really, really good or really, really bad reports, like NVIDIA on the last quarter, where the stock dramatically exceeds what the options were pricing in, sometimes by a multiple of 2, 3, or 4. And if you think you can just come in and buy or short because the stock just moved what the options were expecting and not have a stop loss or something like that, it's a fantastic way to lose a ton of money in a very short period of time. And you also have to be prepared that these markets, after an earnings report comes out, move extremely fast and are relatively illiquid. So again, if you're just trying to place out some bids, which I do at that measured move, and they get hit and it just keeps dumping and dumping and dumping and dumping, you could hurt yourself pretty bad. It happened to me as an example, just to show that I have, my share of trades that go against me or I'm wrong on. It happened to me in Sentinel One when they reported at the end of June last quarter. The stock closed into the earnings report over $20. The next morning, it opened at about $13. I think I took my first buy after hours at about 17. I was $4 out of the money that next morning on a $13 stock. That's huge on a percentage basis. But I was prepared for that with my game plan. My sizing on it was appropriate. I wasn't panicked, even though I certainly wasn't happy that I had stock against me by $4 in a $13, $17 stock. I wasn't panicking either because my size is appropriate. That's actually one of the things I was talking to. I don't want to get totally off topic, so feel free to stop me. But I was having a conversation with one of my traders today who got stopped out of a position basically at the low of the day and took a not so great loss in it. And I was like, well, what was your game plan and why did you liquidate the position at that price? And I feel like the answer that basically came back was, I just hit a point where it was becoming, too much negative P&L and I couldn't hold it anymore. That's not good game planning. Your risk is a function of size and space. So either you needed to have less size, in which case you're not panicking and hitting out randomly because you feel like you're down too much, or much less space. You took that larger amount of stock, but as things are getting heavy like that you're keeping it tight and you're willing to just stop yourself out. And that's really the key to risk management, is really understanding that math dynamic between size and spacing risk.
Interesting. Would you say you tend to trade more or less during these really busy weeks like we're having this week?
More. When things are moving, I trade more. When things are in play, I trade more. When the market's moving on days like today, I tend to trade more. So it moves higher.
All right, let's talk about Apple and Amazon. That's the big focus for most traders this week. Both companies set to report after the close tomorrow. Do you have any plans for either of those stocks? Kind of what's your strategy looking at them? I can see on your positions disclosure you're not in either of them now, but do you plan to kind of watch the reaction and do kind of what you were just talking about?
Oh, for sure. I think this is the first Apple earnings report that I'm not coming into it with stock in years, honestly.
Why? Is there something different in the stock that you're just?
No, it hit my target. Hit my target. I've been in Apple for a long time. I had a target of the stock getting back to like 188 and change or so, or 180 and change. It got there. I liquidated my position. I've traded it on dips on the daily chart a few times since then, not super aggressively. And over the course of the last couple of weeks, as we've come into this earnings season, with me having a little bit more of a bearish thesis and Apple trading at $193 or so, I've just decided to be patient with it and not get back involved and not have a position into the report. Apple and Amazon are huge. They're huge. And it's like I was saying earlier, I'm being generally cautious on the entire market and my positioning until we get through this week. And that's primarily because of the Apple and Amazon report. I really want to see what they look like. I really want to see not just what they look like, but also how the market reacts. Am I going to be looking at another Meta report, which was just incredible? Or am I going to be looking at more of a Tesla Netflix situation of a decent report, but they sell it back down anyway? It's very hard to ever count Apple out of the game. I was just looking at some Apple information earlier today. I mean, I'm still blown by the I think $5.5 billion of debt that they issued in COVID in like 2020, 2021 at like a 1% interest rate of where interest rates are now, and a 40-year debt. They issued 40-year debt at 118 basis points above where I don't know, some treasury benchmark was trading, but the benchmark was zero. So I mean, it's just incredible. Apple could take that cash and like put it in like a SoFi checking account and get 4.4% on the cash that they got, that $5.5 billion at 1% interest rate. If they have a bad quarter, they say, hey, we're buying back even more of our float through buyback. I mean, the buyback is just incredible on Apple. You can really never count that company out. And I was even saying to the team through the virtual trading floor, because I had that price target of about $180, which is where the stock broke down from back in January 2022. That was pretty much highs when the market rolled over.
Right.
Apple is much cheaper at $180 in July of 2023 than January of 2022. It's still $180, but it's much cheaper. Why? Because the float is smaller, because they've been buying back $15 billion or whatever it is of their own stock per quarter for a year and a half coming into that period of time. So, from like a PE ratio perspective, it's naturally going to be a cheaper stock, even if you're just seeing the same, price on your chart. So we'll see. Those are the big ones. I genuinely have no idea. But I'm very excited to see it play out, and I'll probably be trading it after hours.
I was going to say, you tend to be a pretty active after hours trader on big days like tomorrow, right?
On the earnings days, yeah. I actually tend to do more pre-market than post-market in a typical day. The exception to that is earnings season. It's not unusual on like the Apple earnings report day, especially if I've held stock into the report, that I'm still sitting in front of the computer pressing buttons at 8 p.m. when the after-hour session ends.
Okay, so let's get to some audience questions. Our first question comes from Luigi, and he asked, what are your favorite indicators, and are you using any during earnings?
Sure. Thanks for the question, Luigi. I keep my charts very simple. I really don't use many indicators at all. I look at Japanese candlesticks in conjunction with volume and 8 and 21 EMA. I'll occasionally also look at like a 20, 50, and 200 SMA on daily charts, but I keep it extraordinarily simple. I don't have any other indicators at all. It's not to say I don't pay attention to the information when the information is in front of me. And again, this is the great thing about the team that I work with in the ProDesk virtual trading floor, is I'm never going to put RSI on my charts. But if I'm looking at a counter trend trade on a 5-minute chart, I might type into the VTF knowing that some people have a 5-minute RSI on there, and just say, hey, can anyone tell me what the 5-minute RSI is on XYZ stock? It looks to me like it's getting pretty extended to the upside. I'm thinking about going short on it. And if they say it's 82, I might be a little bit patient still and not hit that short button quite yet, and look for another leg higher before coming in on the counter trend trade. So I'm never going to add that to my charts, but if a trader on the team is providing that information, I certainly pay attention to it. And that's true with a whole bunch of indicators. That's true with RSI. It's true with the mark indicators. It's true even, like Pat in his morning note, he uses Bollinger Bands and Ichimoto clouds. I pay attention to all that information, even if I'm never going to have it on my charts. I like my charts to be very clean. And honestly, it's all I need for my own trading. And I find that traders, especially newer traders, tend to become overly reliant on indicators. They're not actually trading the price action. They're trading their Bollinger Band. And that's not enough, because you will see periods of time in which the market just continues to trade below that lower Bollinger Band for significant periods of time and just keeps going down and down and down and down. And you're the trader who buys every time it goes below the lower Bollinger Band, and you're absolutely tearing your hair out because the stock won't bounce, but you were ignoring the actual price action itself because you were overly reliant on this indicator. So I have no problem with traders utilizing them. Just make sure that you recognize none of them are the end all be all. what an indicator is, it's literally that word. It indicates something. It's not like a definite. It's not something to be overly reliant on. So
Right.
Hope that helps, Luigi.
Gillis asked for your thoughts on RBT stock. So it's Rubicon Technologies.
RBT. I just typed it up on my other screens here. I have zero familiarity with this company. I don't recall ever seeing it. It looks like a lot of other stocks. It's been on one of these crazy recent short squeeze runs. Did they actually open this thing at $11? Was this a SPAC? This looks like it was a SPAC.
May have been.
It may have been a SPAC. I just see that back in 2022, it looks like it opened for trading at $10, which is indicative of it being a SPAC. And like most SPACs, it traded from $10 down to 40 cents. The whole SPAC scam. Not that there weren't a few SPACs that went off appropriately, but for the most part, after the first few SPACs, SPACed some of these companies, it really just kind of became one of these ways in which these institutions just rip money out of retail investors who don't know any better, just taking the most garbage companies that are out there and SPACing them because they probably couldn't IPO through an actual investment bank. But anyway, the stock looks like it traded all the way down to 30 cents back here in July. Looks like you've gotten a squeeze, going back to what I was just talking about with a lot of short squeezes that have taken place up to $1.50. I can't really give you any type of strong opinion on this for a number of reasons. One is that I don't know the company. I don't know specifically what caused this, though it looks like it's a short squeeze to me. And I also don't know the person who's asking me the question, who you are. So please don't take any of this as any investment advice. It's not what I'm here to do. If it was my position, I would be selling some into this move. Maybe keep some to see if the squeeze continues. But if it were my position, you just got to run from 30 cents to $1.50. That's a huge percentage return in what I would guess is a garbage company, though I know nothing about it. I would be selling into this move.
It's funny you call it a garbage company. I think they're like literally a waste recycling company or something like that was what I read. So there you go.
Nice.
All right. Vincent asked, do you think RAD is another squeeze like TUP, so RAD and TUP? Are these the new meme stocks?
Oh, they can't kill this Rite Aid. I got a Rite Aid near my apartment. I go there. I use that.
I have one up here in my, they're all over here where I'm in.
I guess they've got some debt issues. I don't know Rite Aid super well. I guess they have some debt issues, and I guess one of the problems also is I think that they don't own any of their real estate is one of the problems. So that combined with debt and where interest rates are, I think is dramatically hurting this. I mean, look. So Tupperware is not in my position disclosure. I shorted the absolute heck out of that yesterday. So you just got to be very careful with these things. And it was one of my best names on my day to day, because the fact of the matter is, in my opinion, Tupperware does not belong at $6. I mean, we saw it with Bed Bath & Beyond. When Bed Bath & Beyond gave that last squeeze up to like $18 or whatever, at that point, the fundamentals had deteriorated so dramatically. There was pretty much nowhere for Bed Bath & Beyond to go outside of a miracle, except for zero. And it's been a really interesting market phenomenon that we have seen really ever since COVID and the meme craze and the Wall Street bets craze, that a lot of these companies, even sometimes as they declare bankruptcy, will rip up like hundreds of percent as they declare bankruptcy. But you got to recognize a company that's declaring bankruptcy, like, I don't know what the actual statistics are, but it's probably 97 times out of 100. Every equity holder gets a zero at the end of that. So if you want to be, a super fast momentum short-term trader and catch that squeeze higher on a company that's declaring bankruptcy or that's going bankrupt, cool. If you can make money doing that, awesome. I can't disparage any way that any person can make money consistently, even if it's not my way. It doesn't have to be the way. I would rather patiently look to come in on the other side of the trade, which is what I was doing on Tupperware. And again, I'm a Rite Aid shopper. I actually like to own companies that I use myself and whatever.
Mm-hmm.
I'm a Rite Aid shopper just because it's the closest drugstore to where my apartment is, not because I have any loyalty to it over, CVS or Dwayne Reed or anything else. But I would just be very careful if you're trading any of these stocks that very much could be zeros, whether it's Tupperware or Rite Aid. I'm not saying 100% that they are, but they very much could be. And it looks like the market's starting to price them for bankruptcy. And they give these types of short squeezes. If you want to take, short-term tactical day trades in them to try to put some money in your pocket, but make sure you got that stop loss in place. Make sure that if you're buying Rite Aid, which went from $1.70 to $2.85 today, $2.86 today. It's a really big percentage move.
Mm-hmm.
And you're buying that thing on the way up at $2.40, and you catch the move to $2.80. That's a nice little clip on a percentage basis to be able to put in your pocket. Just recognize the thing that you're trading, because if you buy $2.40 and that's the top, or you happen to buy $2.86, which was the top, and now that thing is rolling back down, and if you don't stock yourself out, you might be bag holding a zero on this thing, and it's just real dangerous. So I'm not going to say don't trade it, and I'm not going to say you can't make money trading it. All I want to say is be careful and manage your risk, which is always the key to the business.
Leif asked, what is your strategy for taking profits once you are in a winning trade? Do you use a trailing stop method, or do you have profit targets set in stone before you enter a trade?
Sure. So first of all, to Leif, because I know he's a new member of the team, check out the game planning class that you have access to in your training program, because I go over that in detail over the course of an hour plus class. Probably look at that in conjunction with the candlestick class. The candlestick class talks about how I game plan for counter trend trades. The game planning class really talks about how I game plan for with trend trades. So the first part of the answer to your question is, what type of trade am I taking? Is it a counter trend trade, or is it a with trend trade? And you can basically classify every trade that you can possibly think of, bull flags and wedges and whatever, as either a counter trend trade or a with trend trade. They all can be broken down into those two types of categories. Counter trend trades inherently have a very high probability of failure. Therefore, from a game planning perspective, I am going to be much less greedy on booking profits, and I will tend to have targets where I'm taking off 50% of my position 1-to-1 on my risk, cover that risk. I'm taking off more at the ADMA on whatever time frame I'm trading, because the ADMA represents the more immediate equilibrium band as far as technical goes for the market. Most counter trend trades fail somewhere between the 8 and 21 EMA. So the ADMA usually becomes target number 1. The 21 EMA usually becomes target number 2. So I'm very quick to book profit in those counter trend trades. And then maybe I'll hold a small percentage of my position just in case that retracement, which is really all you should be looking for in a counter trend trade, actually becomes a reversal. If it's a with trend trade, the beauty about trading with the trend is that trends can last for much longer than anybody ever expects that they will. So you want to try to hold, if you can, a much larger percentage of that position for a big move, and utilize a little bit more of a trailing strategy over the trimming strategy. And that's how you're going to be able to really maximize your reward. One thing to remember about trailing is that you will never fully liquidate at the top of your P&L. You're always inherently giving some back. And a lot of what I do is a combination. So I'll like to have a bigger position where some I'm going to be selling incrementally on the way up. And a lot of what I'm doing, what I'm looking to sell incrementally back up, is actually rebuy it on dips. Stock gets really extended, I sell some, look to rebuy that stock back into a pullback to the equilibrium area to keep the difference as cash flow, put that in my pocket, and at the same time be trailing a core position based on the 3 trailing rules that I have, which again you can see in the game planning class, which I'll very briefly sum up as pivot, ADMA, catch up, new high. And then based on those rules, I can consistently trail, and you might find yourself in a position for a year because it closed well that day and you kept it overnight, and now you're trailing on the daily chart, and the daily chart just keeps trending higher and higher and higher and higher, and you end up getting just a dramatic reward for the initial risk that you put on. Those are my favorite types of trades. That's what I'm looking for more than anything else.
I think you might have already covered this, but Marco asked, how do you set up your target on a trade?
Sure, yeah. So again, it depends. If it's counter trend trade, it might just be that equilibrium area. If it's with trend, I'll look historically for previous resistance on the daily chart, or I might just be selling incrementally. You know, I'm going to take off a very small percentage of my position every 50 cents, every dollar, whatever it is, and then look to rebuy it more kind of quantitatively than based on the actual technicals.
For the market as a whole, what would you say are the key levels that you're currently monitoring?
Sure. So key levels that have been really, really important to me, we actually cracked a little bit today. Last Thursday's high and low. I know last Thursday was an extremely important trading session. It's July 27th. Wish I could share a screen to answer the question. But the 27th, that was the day after the Fed. The Fed was Wednesday. The day after the Fed was Thursday. It's a very common thing in trading that the day after a Fed day is a trend day. The market gapped up really big on that Thursday off of Meta's earnings. So we had a really big gap up that day. And knowing that the day after a Fed day is oftentimes a trend day, I knew that despite the fact that we're gapping up really big, that trend could happen in either direction. We could have gapped up really big, small time frame moving averages catch up, and then we trend higher, or we sell down, we fill the gap, we continue down through it. And it happened to be that. And that was a day where I was also actually very bearish, and I was shorting the NASDAQ very heavily into that gap up. That's a really important trading session. If you can look at a chart and you can see some candles on it. I've been talking about that trading session every morning and every afternoon meeting that I've been doing in the virtual trading floor recently because of how important that day was. That was a push through failure on the market. That was a breakout failure on the market. The S&P gapped up above all resistance, traded all the way down, closed on lows. It's a big, fat, red, negative Maribozu on the daily chart for the S&P. And that is what I consider to be like a warning candle. I call it a penalty box candle. It's putting the market in the penalty box, but it's within the confines of a market that's still trending up. A market is trending up. It's in a pattern of higher highs and higher lows, but I've got this big, fat, push through failure, negative Maribozu candle. So that high and that low are extremely important going forward. If the market's able to get above that high and negate that candle, we're back on the uptrend. It's an all clear sign. But if we get downside follow through from that and then we start breaking previous pivots, it could be the beginning of the break of the uptrend. So that high and that low were just extremely important to me because if we get above that high, we're good. If we get below that low, we're no good. And today the S&P, with everything that happened, broke below that low. So it's kind of a big deal that we got follow through today. We still haven't broken the uptrend. We're still overall in a daily pattern of higher highs and higher lows. We're testing the 21 EMA on the S&P, which is what I consider to be the lower band of equilibrium of this uptrend. We did close on lows, though, so it's not great. But we got a little ways to go before this uptrend shows any signs of a full reversal or a lack of continuation. The interesting thing was that the IWM actually broke above last Thursday's high, that Thursday the 27th, the day after the Fed, where the IWM also got wrecked down. The two following days, the Russell showed a lot of relative strength, and the Russell tends to be a leading index and was actually able to get above IWM 198. So I'm looking at the SPYs and the Qs failing to get above, the IWM actually getting above. And I was like, wow, this market's so resilient. We're negating that, and we might actually be, continuing the trend. But it was never confirmed by the S&P and the NASDAQ. So what you ideally want to see is all three indices confirming one another. The S&P is above the level, the NASDAQ's above the level, and the IWM is above the level. We did not get that. And now the IWM is potentially a failure, though it hasn't broken Thursday's low. But the SPYs and the Qs broke last Thursday's low. So this NASDAQ is not looking good right now, though it could be totally saved tomorrow by Apple and Amazon or look significantly worse. That's the first spot that I'm paying attention to. From here, QQQ 370 is really important looking. That's a spot that we broke out from previously. So maybe a retest of that. The market might attempt to hold it as some support. And similar but different with SPY, like 444, 445, which we're $5 away from. So that's what I'm paying attention to next on the downside.
tell me about the best trade you've had this week and what made it go right.
The best trade that I had this week is probably not any one individual trade. It's probably the adjustment of my portfolio to get short. I'm pretty rarely net short.
Right, yeah,
again,
you don't often trade to the downs or trade short.
I don't.
No.
And if anything, actually, it's sometimes a criticism of my trading that I receive from other people, whether it's justified or not, is a different story. I have no problem being 100% long when the market's breaking out and moving higher and higher and higher. But I do have the flexibility to get short at times. I am able to do it if I can convince myself to do it. Most of the time, I like to own my longs and rent my shorts. Like I like to really have those longs and keep them for a while and ride those uptrends. I mean, look, I'm a product of my market environment. I started trading professionally with T3 in 2010. Go look at a chart of the S&P from 2010 to 2023. There's pullbacks in there. There's pullbacks in there that you can make money off of. There's pullbacks in 2015. There's pullbacks in the end of 2018. There's a big pullback when COVID hit, obviously. There's some very big pullbacks over the course of those years. But if you just take out 4 or 5, relatively big pullbacks that we've had over the course of a 13-year professional trading career, would you rather broadly be a person who trades to the long side or a person who trades to the short side? And I think that the answer to that is to the long side. But we also have to have a degree of mental flexibility and be able to adjust. And I'm not afraid to go short when we see the signals actually change. And for me, as a person who tends to want to lean long, it's a big W for me that I was able to kind of see everything that I was able to see with the market, which we already went over a little earlier in this interview, to actually say, you know what, I want to piece out of these shorts to a large degree, not immediately get back into them, not jump right back. I'm all out of, I've been long Apple, Amazon, Google for a long time. I'm all out of all of them. I haven't jumped right back in, and other stocks as well. So I'm not jumping back into the long side. I'm flipping short, and and then getting the follow through today. So I think it's just a combination of the Qs short, the UPro short, Meta, Microsoft, Tesla, put them all together. That's my best trade of the week.
I'll ask you about your worst in just a second, but Ryan said he agrees on Apple, can never count it out, but what about Amazon? What will you look for in their report?
First thing I would say is I tend to do most of my earnings research the day of the report. So since they're reporting tomorrow, I'm probably doing most of my research on it tomorrow. I don't really know what the expectations are coming into the report right now. I'm pretty neutral as far as my thought process is on Amazon. It seems like it's a little bit more expensive than like a Google or a Microsoft is right now. AWS numbers are going to be huge. Is there any chance that some of these other companies have started to chip away a little bit at AWS's dominance in cloud to a certain degree? We'll see. There's been renewed chatter also recently, and I don't know if it'll be mentioned by the company in the earnings report. It's been renewed chatter about the government coming in and breaking up Amazon. Be interesting to see if management says anything about that in the report. I'm going to guess that they're not going to, that they're going to try to ignore it. I do think that Amazon is worth more broken up. I think that the sum of the parts is worth more than the whole. And what I would really want to be an owner of really isn't like Amazon.com's marketplace. It is that AWS machine that they have. I don't want to own Amazon Prime's streaming service if that ever had to become its own company. So we'll see. I don't have a lot of expectations at this point. I have more research that I need to do, but it'll be an interesting one for sure.
Okay, and then we'll end here kind of on a lesson side maybe. So tell me about the worst trade you've had over the past week. It doesn't have to have been in the past 3 days, over the past 7, whatever. What made it go wrong and what you learned from it.
So I haven't really had any except I've never been an options trader,
Mm-hmm.
but I decided to add on options into my account to
I was gonna say you've
test
got quite a few options, quite a couple options on your positions
the
disclosure.
thesis.
So.
Yeah.
Mm-hmm.
So generally, what you see on there are just a few covered calls that I
Right.
was experimenting with on a different strategy that I have. So I do have some an outright pins put. It's probably going to be worthless unless this market just dies and brings pins down with it. I mentioned earlier that I had a thought process coming into this earnings season, since we've come up so much, that if earnings came in mediocre for a lot of reports, that they would tend to sell off.
Mm.
So I wanted to put my money where my mouth is, because that's the type of person I am. And I decided to add options on in order to buy very small, because I'm really not an options trader. Some puts into some reports to literally 100% gamble, and that's what I've been saying to the people on the team as I've been doing it. And I am 0 for 6, I think, on the puts that I bought into earnings reports.
Okay.
I had some puts on Microsoft, which I tend to be super bullish on Microsoft. I love the company, even though I'm actually short the equity right now. I had puts on Meta. That report was excellent. I had puts on 2 different sets of puts on Roku. That report was phenomenal. You know, puts on pins for yesterday. That report was solid. Even though the stock hasn't reacted great to it, it's not enough.
Expenses were really high. This was the focus, is what everyone says.
Right.
Yeah.
And you know, but not high enough for
no, it
pins
turned
to go
around
down enough
today. Yeah.
to make money on that. So I can't even necessarily count it as a bad trade, because I did exactly what I was set out to do.
Right.
I had a thesis coming into an earnings report. I literally said, hey, everyone, I am going to 100% gamble on my thesis on a few random earnings reports on stocks that have gone up a ton into the reports, just to see if maybe they have mediocre reports to sell off. And I've happened to do it on pretty consistently amazing earnings reports, and have lost money on every single one that I've done. So my hit rate on my options trading career has not been so good. The covered call stuff is actually working out fine.
Yeah. You've mentioned your virtual trading floor a couple times. For those who don't work with Derrick or aren't familiar, he is the leader of the ProDesk virtual trading floor with T3 Live. That is a service that all T3 trading group traders have access to as well, as part of being a member with being a licensed trader with T3 Trading Group. How important is it for you to have that community of traders with you every single day versus trading on your own?
It's massive. I wouldn't be able to do what I do without the virtual trading floor. Like I would not be able to trade the way that I trade. I would not have gotten short if it wasn't for the virtual trading floor. All the data that I utilized really to have my thought process flip to get to the bear side of the market, a lot of that came from Pat's note. It's just an amazing community. The community makes me money, and I like to think I make the community money. They present ideas to me that I never would have seen on my own, or they give me alerts on things that are moving that I would never have seen on my own. And I'm able to get involved in it and make money for myself in certain spots. And in turn, I certainly hope, I publish a list every single morning to the virtual trading floor of the stocks that I'm looking at the potential price points that I'm looking at, and why I'm looking at them. And it's got a pretty good success rate, that list. So, if you're in there and you're following along with that, and you're following along with some of the trades and the ideas, I hope, and I would expect that it's making you a better trader as well. It's a phenomenal community. I've been saying it from the beginning. It's called the Pro Desk for a reason. This is not the Derrick Oldensmith room. This is a community of like-minded professionals who are approaching this market with trying to do this as a living, as professionals. And there's very little, if any, BS banter that's going on there. We're all about the money. We're all about the ideas. We're all about the information. And it's a phenomenal group. I highly recommend that people check it out.
Okay. Thank you so much, Derrick, for being here with me for today's event. For the audience, hope everyone enjoyed. If you have any questions for Derrick, I know you can reach out to him on LinkedIn specifically, correct, Derrick? Or directly, not
Yes.
specifically.
You can reach
All
out to me through LinkedIn. You can email me, doldensmith at t3trading.com. Plenty of ways to get in touch with me. Go to the T3 Trading website. You'll be able to get in touch with me. Let's make it happen.
Yep. All right. Next week, I will be back with a new guest, Brant Hirsch, who is another professional trader, licensed trader with T3 Trading Group, has not been here before. His event page is already up on the T3 Trading Group LinkedIn page. So everyone go ahead and register for that. We'll be back next week at 4:30 p.m. Eastern. Thanks, Derrick, for joining me today.
Thanks, Greta.